SiteOne Landscape Supply just posted a massive Q2 2026 earnings beat across the board. And they did it in a macro environment that, by all logic, should be absolutely crushing them right now. We are looking at top-line revenue of $1.53 billion.
Right.
So that is up 5% year over year. Net income attributable to the company increased 8% to $139.3 million.
Yeah, and adjusted EPS came in at $3.14, handily beating the 2.86 from the previous year.
Exactly. And looking ahead, management is guiding for full-year adjusted EBITDA between $425 million and $455 million. And that is despite completely flat organic growth. The market loved the resilience, with the stock catching a strong bid right out of the gate. So we are breaking down exactly how the biggest nationwide player in hardscapes, irrigation, and agronomics actually pulled this off.
Because, the headline numbers paint this picture of a growth company just firing on all cylinders. 5% revenue growth and an 8% jump in net income. Well, that's a phenomenal quarter for an industrial distributor.
It really is.
But when you look at the underlying end markets they serve, this Q2 report is less of a standard growth story and more of a masterclass in structural resilience.
Yeah, because if you just glance at those top-line bullets, you would assume home builders and commercial contractors were having a banner year.
Right. You'd assume everyone is putting in new patios and resodding their lawns.
Exactly. But we pulled SiteOne's Q2 earnings release, their investor presentation, and their 10Q, and the data inside reveals a pretty massive paradox.
It really does.
Because organic daily sales, which strips out the impact of their acquisitions and the varying days in a quarter, only increased by 1%. The end markets are basically freezing over.
They are visibly contracting. Management explicitly states that new residential construction is down high single digits. The repair and upgrade market is down mid-single digits.
Down mid-single digits. That is tough.
Right. We are looking at a harsh macro storm characterized by economic uncertainty, weak consumer sentiment, and massive affordability concerns driven by rising interest rates.
Which changes everything for the consumer.
Exactly. When mortgage rates are elevated and consumer confidence is shaky, well, existing homeowners simply do not finance a $50,000 outdoor fire pit and retaining wall installation.
No, they definitely wait on that. And on the builder side, they pull back on new subdivisions entirely, which means less new irrigation piping, fewer retaining walls, and just zero new turf going in.
Right. The volume just evaporates.
Okay, let's unpack this.
Yeah.
It makes me think of SiteOne operating right now like a well-insulated greenhouse during a harsh winter frost.
I like that analogy.
Yeah, the outside environment is freezing, but somehow, inside their financial reports, they're still growing. If organic volume is practically flat and their primary customers, the home builders and upgraders, are actively pulling back, how exactly are they expanding margins and growing revenue by 5%?
Well, the answer lies in their pricing power and how they manage their unit economics. Because they couldn't rely on organic volume, meaning the actual number of physical concrete pavers and bags of fertilizer going out the door didn't surge. They had to drive growth by widening the spread on the products they did sell.
Which shows up right in the gross profit.
Exactly. We see this clearly in the margin data. Gross profit for the quarter increased 6% to $564.5 million, and they expanded their gross margin by 50 basis points to 36.9%.
And they generated that expansion while absorbing $966.2 million in cost of goods sold. They're clearly dealing with inflation on the supplier side for things like raw plastics and chemical fertilizers. But they aren't eating those costs. They pushed a 3% price increase straight onto the end consumer.
What's fascinating here is that inflation is typically a margin killer for distributors. If you get caught in a standoff between rising supplier costs and stubborn customers who refuse to pay more, your margins just get crushed.
Right, you get squeezed right in the middle.
Yeah, but SiteOne avoided that trap. They utilize what they call commercial initiatives to protect and actually widen their spread. They use their market dominance to force that 3% price hike through.
They had to do.
They absolutely had to do this because their SG&A, their selling, general and administrative expenses ticked up 30 basis points to 24.2%.
Which directly reflects the lower overall sales volume, I assume.
Yes, exactly. But because the gross margin expanded by 50 basis points, it more than covered that SG&A drag, dropping the excess right to the bottom line.
But at what point does that rubber band snap? Passing a 3% price hike down to local landscapers works on paper, But a local landscaper can only raise their prices on homeowners so much before the homeowner just decides to cancel the project or mow their own lawn.
That is the big question.
Are they generating real foundational growth, or are they just inflating the balloon until their customers can no longer afford the inventory?
You're right to question the breaking point of the consumer. And the 10Q actually lists that exact scenario under their risk factors. They acknowledge their business is highly sensitive to volatility in the prices of the products they purchase.
Makes total sense.
Right, so if commodity prices for the plastics used in irrigation systems spike too rapidly and they pass 100% of it down, they risk total demand destruction. But the reason the rubber band hasn't snapped yet comes down to the deep fragmentation of their customer base and the specific nature of the service they provide.
Yeah, because if you have ever tried to hire a landscaper for a backyard patio, you know their biggest bottleneck isn't usually the cost of a bag of sand. It is time and labor.
Yep, time is money.
They need the materials ready at the yard at 6:00 a.m. so their crew can get to the job site and actually bill for the day.
Exactly. A massive portion of SiteOne's customers are small, local, mom-and-pop operators. For them, SiteOne isn't just a place to buy dirt. It is their warehouse, their credit facility, and their supply chain manager.
Ah, so it's a structural advantage.
Totally. SiteOne provides a level of inventory reliability and immediate availability that local independent distributors simply struggle to match during inflationary periods.
So they just pay the higher price.
Yeah, the local contractor will swallow a 3% price hike if it guarantees they have the specific paver they need in stock to finish a job on time and get paid.
Okay, but even with that pricing power holding strong, a 3% price hike and a 1% organic growth rate still do not equal a 5% jump in total net sales. That missing revenue is coming from their second growth engine, which is their aggressive acquisition machine.
Right. Acquired sales contributed $49.2 million to net sales growth in Q2. That represents about 3% of that total growth, which perfectly fills the gap.
So they are essentially buying the top-line growth that the macro environment will not give them organically.
Yes, exactly. They acquired the remaining 25% interest in Devil Mountain Wholesale Nursery during the quarter. And if we connect this to the bigger picture, this aggressive M&A strategy is the entire foundational thesis of the company.
Because we are looking at a $36 billion industry across the United States and Canada. And according to their presentation, 87% of that market consists of small, independent operators.
The scale of fragmentation is staggering. SiteOne is the largest and only nationwide full product line wholesale distributor in this entire space. They are approximately 3 times the size of their next closest competitor.
Wow, 3 times.
Yeah, yet even with that dominant scale, they only hold about a 13% market share.
I just picture SiteOne as Pac-Man navigating this massive $36 billion maze. They are just methodically gobbling up these local independent nurseries and hardscape suppliers dotting the map.
That is a perfect analogy.
They buy a regional player, plug them into the corporate supply chain, rip out the back office inefficiencies, and move on to the next dot in the maze. So does this mean their primary competitive advantage isn't necessarily their product selection, but actually their M&A integration process?
I would say it is their defining core competency. Their strategy is built entirely on being the ultimate industry consolidator. They leverage the deep pockets, purchasing power, and technological infrastructure of a corporate giant.
While still keeping that local feel.
Right. They intentionally maintain the entrepreneurial spirit of the local area teams they acquire. When they bought that remaining 25% of Devil Mountain Wholesale Nursery on June 1st, it was the culmination of bringing a highly specialized, respected local brand fully under the corporate umbrella to capture all the associated earnings.
But playing Pac-Man requires a lot of quarters to feed into the machine. You have to fund those acquisitions. When we look at their cash flow statements, the cash generation of this model is formidable, even in a housing downturn.
It really is.
Cash provided by operating activities in the second quarter increased by $16.5 million, hitting a total of $153.2 million.
They also fortified their balance sheet by amending their ABL facility, extending its maturity out to April 2031. Securing that extension gives them a massive runway of liquidity,
leaving them with $443 million in available capacity on that facility, alongside $87.4 million in straight cash equivalents on the balance sheet.
which gives them a ton of flexibility.
Here's where it gets really interesting, though. Their capital allocation gets highly debatable. Instead of taking all that cash and deploying it into buying up more of that 87% fragmented market, They repurchased $93.8 million of their own stock during the second quarter.
Yeah, they went heavy on buybacks.
And they didn't stop at the end of the quarter. In a post-quarter event in July 2026, they bought another 100,692 shares for roughly $10 million at an average price of $99.29 per share.
Right.
They still have $90.5 million remaining on their repurchase authorization. If they only have 13% of a $36 billion market, why spend over $100 million buying their own stock? Shouldn't literally every spare dollar go toward acquiring more independent operators before competitors catch up?
It is the ultimate capital allocation test. Do you buy market share, or do you buy your own earnings? Executing a massive share buyback in the middle of a cyclical housing downturn sends a very potent signal from management.
That they think they're cheap.
Well, first, it proves they have the bulletproof liquidity to easily weather the current macro headwinds. They aren't hoarding cash out of fear. And second, yes, it shows they believe their stock is fundamentally undervalued by the public markets. They are looking at their internal projections and deciding their own equity is mispriced.
So they are comparing the ROI of acquiring a local nursery at a standard EBITDA multiple against the ROI of retiring their own shares at current market prices.
Exactly. And deciding their own stock is currently the better bargain. Plus, it offsets any dilution from stock-based compensation, which they use heavily to retain the leadership of the companies they acquire.
Ah, that makes sense.
But your challenge on the opportunity cost is completely valid. Every dollar spent on a share repurchase is a dollar not spent capturing the remaining 87% of the total addressable market.
Right, it's a trade-off.
However, because they just extended that ABL facility out to 2031, they have enough dry powder to execute both strategies simultaneously. They do not have to choose between M&A and buybacks.
Well, if they're willing to drop $100 million on their own stock, we have to look closely at their official guidance for the rest of 2026. What do they actually see coming down the pike? Management is remarkably pragmatic here.
They really are. They are not predicting a sudden miraculous recovery in the housing market.
No, they explicitly expect the challenging macro trends in new residential construction and repair to persist for the full year.
Which means they will have to continue leaning heavily on that pricing power. They project organic daily sales to be flat to up 1% for the full year.
Barely moving.
Yeah, they are relying almost entirely on that 3% price inflation and their commercial initiatives to keep revenue growing while end market volume stagnates.
But even with those volume headwinds, they still project full-year adjusted EBITDA to land between $425 million and $455 million.
Implying they expect their margin expansion to hold.
There is a bizarre, quirky detail buried in this guidance, though, that illustrates the mechanics of this business perfectly. Fiscal year 2026 for SiteOne has a 53rd week ending on January 3, 2027.
This raises an important question about how financial calendars work.
Yeah, because this single extra week actually has a $4 million to $5 million negative effect on their adjusted EBITDA.
Right, because public companies operate on rigid 13-week quarters to keep year-over-year comparisons clean, which inevitably forces a 53-week catch-up year every so often.
Right.
But because of the extreme seasonality of the landscaping supply business, that specific extra week in late December is functionally dead.
It is genuinely amusing that merely existing for an extra week actively damages your bottom line. They have to pay a full week of SG&A expenses.
Yes, salaries, rent on massive supply yards, utilities, fleet insurance.
Exactly. All of that during the week between Christmas and New Year's, a time when sales volumes in landscaping are practically at zero. Nobody is pouring concrete or laying down sod in the Northeast on December 29th.
It perfectly illustrates the intense fixed cost leverage inherent in their model. During the peak spring season, when organic volume is surging, those fixed costs are absorbed effortlessly and margins explode upward.
But when volume vanishes in late December, those exact same fixed costs become a heavy anchor dragging down the full-year EBITDA.
Exactly.
Which brings us to the ultimate question for the stock. We're looking at a company dominating a $36 billion fragmented market. They are facing a freezing housing environment, yet they are successfully flexing their pricing power to expand margins.
Right.
They are utilizing a Pac-Man strategy to drive top-line growth and generating enough cash to buy back $100 million of their own stock. So what does this all mean? If their margins are expanding right now while they are fighting uphill against a terrible macro environment, what happens to the bottom line when the housing market eventually thaws and organic volume actually returns?
The operating leverage during an economic upswing could be explosive. If they can streamline their operations and force price increases through during a downturn, the flow through to EBITDA when volume actually returns will be substantial.
Oh, for sure.
But there is a different kind of forward-looking constraint we need to factor in, and it's pulled directly from the risk factors disclosures in their 10Q and the disclaimers in their presentation.
The fine print always has the best secrets. What did they flag?
Well, we spend so much time analyzing financial reports through the lens of interest rates and consumer sentiment, but this is a business inextricably tied to the physical earth. Their disclaimers heavily cite severe weather and climate conditions alongside seasonality.
Right, because a company selling dirt, fertilizer, and irrigation systems is completely at the mercy of the natural world.
Exactly. They specifically note that variations in weather patterns, like, unusually long winters or heavy rains, directly paralyze their customers' ability to work.
I mean, a landscaping crew cannot lay down a patio in a flood, and they cannot install an irrigation system in frozen ground.
Exactly. But the more pressing long-term risk they cite involves prolonged droughts and water conservation regulations.
Oh, wow.
Yeah, if municipalities and major markets ban watering lawns due to climate-driven water scarcity, the demand for turf, fertilizer, and irrigation fundamentally shifts. As climate change visibly alters weather patterns and impacts global water availability, it begs a crucial question for the terminal value of this company.
Will the ultimate ceiling on SiteOne's $36 billion market be an economic constraint dictated by the Federal Reserve or an environmental constraint dictated by the physical limits of the climate? It completely shifts how you value their long-term growth.
It does. It is a stark reminder that behind every ticker symbol and earnings beat, there is a physical supply chain dealing with real-world physical limitations.
That is a phenomenal dynamic to track going forward. For everyone listening, make sure you follow the show for daily earnings coverage. As we continue to break down the mechanics behind the market's biggest movers, keep digging, and we will catch you on the next deep dive.